Hello, and welcome back to DoubleLine's Channel 11 News. I'm Ken Shinoda, Portfolio Manager at DoubleLine, and your host today, Thursday, August 27th. August was another month of risk on across markets. The S&P 500 and NASDAQ both hit record highs, up over 6 to 8% on the month, with the NASDAQ up an insane 30% year-to-date. Other developed markets also saw gains, with the Euro Stoxx 50 almost up 5 on the month, and the Nikkei pushing ahead another 7%. However, both indices are still down on the year. U.S. equities continue their resilience outperformance relative to the rest of the world, and growth continues to massively outperform value. The Russell 1000 Growth Index is up over 29% year-to-date, compared to the Russell Value Index, down almost 10%. The Russell Gross has pushed to the largest relative outperformance ever versus value. At some point, value stocks, which include sectors like banks, industrials, and energy today, seem like a buy. But it sure feels like catching a fallen knife. And those sectors require real economic growth to drive long-term performance, not just the monetary growth that we've seen thanks to the printing press of global central banks. Divergence is also seen in the emerging markets, with Asian equities making new highs given their heavy growth-oriented exposure, while LATAM and EMEA trade sideways. When we look under the hood of the global stock market, tech and growth seem to be the engines of return. One of the big questions facing investors and discussed ad nauseum in financial media is when growth in tech will run out of steam. Valuations surely seem stretched, breath waning, and bullishness at extremes. Only time will tell, and the bloodless verdict of the market will tell us what lies ahead. It truly is quite astonishing just how few stocks are driving index returns today. When looking at the S&P 500, the top 5 stocks by market value are up 52% year-to-date. Apple, Amazon, Microsoft, Google, Facebook. Sound familiar? While the rest of the S&P as a basket is down just over 3% on the year. The theme of winners and losers we talked about on our last episode of Channel 11 continues in full force. As we look at the commodities complex, we also see a divergence, with most commodities down on the year, in line with the greatest economic shock the globe has seen since the Great Depression. Precious metals, on the other hand, especially gold and silver, have joined the exuberant rally of growth in tech, up 26 and 50% year-to-date, as investors seek protection from the central bank printing press, or perhaps some alternative to fiat currency. Not surprisingly, Bitcoin, cryptocurrency, is also up a whopping 57%. While gold has no income nor yield, in today's crazy world of bonds, no yield is better than negative yield. In fact, there are over $14 trillion of negative yielding bonds that investors and foreign central banks can't seem to get enough of. I know, maybe rates can go more negative, so these negative yielding bonds are cheap today. I'm proud to say I've never bought a negative yielding bond at issuance. Can you? Perhaps it's no surprise that TINA, there is no alternative, continues to push investors into places like gold and equities. At the Jackson Hole event this morning, Federal Reserve Chairman Powell announced a major policy shift from targeting 2% inflation to a policy of average inflation targeting. This means inflation can run moderately higher than the Fed's 2% goal for periods of time. Mr. Powell said, the changes reflected lessons the central bank officials had learned in recent years about how inflation didn't rise as anticipated when unemployment fell to historically low levels. Based on this policy shift, the Fed seems content to keep rates low and not raise interest rates for a very long time. Not surprisingly, the market's inflation expectations have been on the rise recently after collapsing into the depths of darkness that was March of 2020. Gold and equities should do okay in an inflationary environment, and to be sure, are an important core holding for investment portfolios. Inflation is a hot topic. Are we going to see inflation? Or are the extreme levels of debt growing in the system a longer-term deflationary force, in which cash and/or long-duration government bonds would be the preferred investment? I guess these divergent views and potential outcomes are what make markets, and why we as investors must create diversified portfolios. Looking at catalysts out there, it seems as though the coronavirus has taken a back seat for now, even with virus cases picking up in Europe. China trade wars and Iran headlines are back in the news, and of course, how can the media resist Apple surpassing $2 trillion and Tesla up 56% since they announced a 5-to-1 stock split earlier this month. Robinhood traders are having a field day, week, month, year. One blog I saw, someone joke, I hope, that Tesla was giving away free shares, 5 for every one you own. Sign me up, Elon. I guess it's business back to usual as all eyes are on Washington, the election, and what the size and scope of the next fiscal package will look like. It sure seems like Congress works together better when stocks are down. What's the rush after all, with stocks at new highs? Just the welfare of the majority of American people? Let's hope our fearless elected leaders can get their act together sooner than later. Well, here we are. Labor Day is around the corner, and we're 67 days till the presidential election. Many stock portfolios have retraced most of their losses from March and even made new highs. Gold held an all-time intraday high of 2075, and bond yields remain extremely low. Although credit has seen a decent rally, especially in investment-grade corporate bonds, many parts of the U.S. credit markets are still below their pre-COVID prices. Is there opportunity out there? Or is the bond market telegraphing risks that the equity market has brushed off as it continues to stretch to new highs on what seems like a daily basis? Here to help us answer that question is Robert Cohen, head of DoubleLine's Global Developed Credits Group and a longtime colleague of mine. Welcome to the show, Robert. Robert, thanks for joining us. We'd love to talk about credit today. We've seen a pretty big rally in the credit markets. Investment-grade corporate bonds leading the way, sitting at all-time lows in yield, sub 2%. Even high-yield bank loans have had a good run, but they still haven't gone back to the prices of the pre-COVID levels. So is there opportunity out there, or is the bond market telling us that there's some risks that the equity markets may be brushing off?
Well, I don't think of it as a sort of early warning signal or anything. So sometimes you see equity markets roar, but then credit starts deteriorating. So we haven't seen that at all. If anything, credit has been improving just at an uneven pace. Okay. So I think the opportunity really is trying to figure out in the credits that maybe haven't caught up so fast, which of them are going to be survivors and make it through, and which really have sort of problems that can't be resolved.
Yeah, I mean, there's a theme of winners and losers that we always talk about, you know, what the Fed buys, what the Fed doesn't buy, and also the different sectors of the economy that are hit harder by COVID. So I think it's really important to investors to know that security selection is extremely important at this point in the credit markets. You shouldn't just be going out and buying HYG or J&K or BKLN to get exposure. And you know, a lot of work goes into selecting those credits. So I think it would be interesting for our viewers to hear about how we approach credit at DoubleLine, how you and your team like to approach it.
Right. So below investment grade credit really is a bottoms up, very, very much a bottoms up process. We start with looking at the individual company and think about how it competes relative to other companies in that sector or across the economy. So we're not just looking at the financial statements. It's more broad than that. We want to know, what are their competitors like? We talk to the management team. Sometimes we'll talk to the sponsor, the equity sponsor that owns the firm. We'll even use expert networks for people who might be smarter than us in things like the chemical industry or technology. And so we want to build a knowledge base really over years, not days or weeks. I think some of our best ideas are from covering companies over many, many years. We understand really how they work in good times and bad. And then when there's an opportunity, we have the background of all that information to put to work. We use that, and then there's a couple basic tenets of loan to value and liquidity. So, you know, you want a level of cushion. So loan to value would simply be if you have a company that's worth, let's say, $1 billion, you want to have some cushion to that. So you want to have maybe only $500 million of debt. And that type of loan to value analysis gives you cushion. But ultimately, the one thing that saves you more than anything else is liquidity, which of course we're seeing in the current times, sure, usually not provided by the Federal Reserve, but companies that have liquidity have time. So if there's periods of stress, that liquidity gives them time to figure it out. So part of our, you know, those I say the two key attributes that we focus most on is liquidity and then loan to value, but put it together with this really understanding of the credit itself. The other thing that we really is fundamental to the way we operate is we want our investment analysts to be industry experts. And so that's why we're organized by industry. So the person who covers healthcare, they're supposed to know not just their names in our portfolio, but what's going on in healthcare. Sure. There's a lot of regulatory issues coming up. with an election that's coming up, and what do all those mean for the portfolio? And so by having someone who spends time thinking day in and day out what's going on in healthcare, it builds this expertise.
Yeah, you said something earlier that I feel like is a big topic today. It's basically kind of getting to the other side, right? So rates are low, the Fed stepped in, allowed bonds to be issued again, allowed companies to be able to go issue securities in the marketplace and borrow at historically very low levels. And so debt levels, however, are very high. And I guess the bull case is that, yes, debt is high, but the cost of debt's low, so debt coverage is still pretty solid. But then what about these zombie companies? I have a lot of investors asking about the zombie companies that have a lot of debt and that's the only reason they're alive. Is that a valid point? Do you see risks like that out there?
Oh, for sure. If you look at mainly the COVID space, there's a tiering of companies that are likely to come back soon and some that will take quite a long time. Gaming has performed better than I would have thought. They are coming back more quickly. Actually, the Las Vegas numbers are out now and they're only down from gaming revenue, down 26%. It sounds like a lot, but they were closed.
People love to gamble.
They were closed at some point.
Sure.
So, it's addictive. So people are gambling. So maybe that comes back a little faster. And you look at things like cruise lines, it seems like that's going to be a long slog. Although if you look at public earnings, so consensus estimates for public companies, looking at revenue, the thing that's the most easy to measure, it has many of them coming back, even cruise lines and airlines coming back to nearly 100% in 2022. So some of the
This is the earnings estimate.
This is revenue, just revenue, because earnings there can be manipulation,
Sure.
but revenue is revenue, so it's easier to track. So even some of the worst COVID sectors, the market thinks they're coming back in 22, and so that's a question: is the market right or not?
Yeah.
And I think in some places yes, in some places no. That's where you have to do the fundamental work. It is true that I take cruise lines for example. If the market wasn't there providing liquidity, they wouldn't make it. They have excess liquidity because of the environment we're in.
It wasn't one of the first bonds in the high yield market to actually get done was a Carnival Cruise Lines, right?
Carnival Cruise. Simple elevator pitch on that is you're secured by all the boats. And so if the cruise line doesn't make it, now you're foreclosing on, I think, 80 ships. Okay. The loan to value on those ships is somewhere on the order of 10%. So you're making that was an 11.5% bond, and so you're not making 11.5% without taking some risk. Sure. But the hope is with an investment like that, if you wait long enough, there's a way to work that out. It's a lot different than being the unsecured capital at the bottom of the capital stack, where if the company needs to get restructured, there's not much left to that's probably the first thing to be impaired. But that first lien position gives you some level of cushion. So it wasn't insane, but
that seems like a good example of something that on the cover when I saw that I said, oh, that sounds really risky. But there's bells and whistles that they kind of put into the transaction where you're collateralized by real estate or collateralized by boats in this case, right, that make it interesting. As you look at, you talked a little bit about the different sectors of the market, and some are more COVID related. What have been the most resilient parts of the market? Clearly, everyone kind of knows tech because they hear about all the FANG stocks off to the races. But in the credit markets, what have been the most resilient parts of the market thus far?
Well, tech makes up a pretty significant amount of the below investment grade market. It's actually about 15% of the bank loan market, a little less in high yield. It's probably 5 or 6%. And that, of course, is rock solid. That's the infrastructure that allows for a work from home setting. So sure, that's of course growing in this environment. Supermarkets. So supermarkets, there were credits in the high yield space that 2 years ago we thought were really problems because you had Target and Walmart, yeah, Costco providing competition in that space, and those companies were to some extent suffering and their performance was deteriorating. Then COVID comes and we're out of toilet paper, and
that's the one place to go. You may not be going to Nordstrom's, but you're going to the supermarket.
You
right?
have to go to the supermarket, and that sort of displaced restaurant activity. So supermarkets are a bright spot, which no one would have predicted in 2019. I think I would have said tech is a place to be in 2019. Yeah. I never would have thought supermarkets is a hot spot to be in 2020. So that's an example of something that was kind of a surprise.
And then so what's kind of the troubled spots? Like clearly, hospitality, however, gaming being a shining light, so kind of a mixed bag. But what are the other kind of big concerns out there?
Well, I think the really problem sectors that were a problem before COVID and will likely suffer after: energy and retail.
Okay.
So retail is being displaced by the online trend that's happening. So there's really just retail platforms, retail concepts that don't work in even with the trends of online, but in a post-COVID world, they're really just it basically don't work anymore. Energy really is a scale business, and the high yield market financed a lot of credits that don't have scale, and so they're just going to have to fall away. So even if we're in a gradual recovery phase in the economy right now, I think those sectors are going to struggle no matter what. They were struggling before, and I think they're going to continue to struggle. Even if oil recovers, you can see these subscale players just falling away because the market's unwilling to continue to finance their growth.
Yeah, I mean, how about the effect of on the real estate market? Like, do you see companies out there as one of the ways they're going to try to save money? You talked about working from home. You know, they just don't need the office space. Do you really need to sell retail in a brick and mortar shopping mall? Can you just do it online? There's been all these brands like the Allbirds shoes that everyone seems to be wearing everywhere, especially the millennials. I mean, they don't have any stores in the mall, but they've been done all through Instagram and things like that. So do you see a shift on a way that companies can cut costs? Is perhaps they don't need as much real estate, right?
Oh, absolutely. So they are implementing more tech. Goes back to technology. Technology solutions can bridge some of the business operations that you did in an office. So certainly that's the case. And that's why you also see telecom as an area of growth, whether it's wireless with your cell phone or providing high-speed internet access. These are the type of things that enable the ability to work remotely. So I certainly see that as a growth area. And then we're seeing certain credits that are suffering because of that. One is a company that provides office supplies, which was sort of a stable business focusing on business, not the individual, or schools. That credit is suffering right now because who knows when people are going to come back to the office, and when they do, what percent is it going to be? 20% of the workforce, 80%? We just don't know. There's a lot of uncertainty in those situations, and those are the type of credits where I think you have to avoid the things where you have this sort of like binary risk, where if everything works perfectly, then this credit will survive. But anything less than perfect, it falls apart. Those are really where the big losses happen, where you're sort of counting on perfection with no room for error. And
you're
those are
counting on like oil prices above some level for survival.
Oil
right?
going back to 80, I mean, that's obviously the most optimistic thing that if you're betting on that, that's probably not a good credit to be in.
So, bank loans, high yield, where's the place to be? Can you tell our viewers a little bit about kind of each of those markets and how do you see the setup for them?
Yeah, so I think the distinguishing thing about high yield is the preponderance of double Bs, which has been growing over time. It really was born out of the energy crisis. So you think about high yield financed the boom in energy, particularly in the shale plays in Texas, in the US. And so you built up a lot of risk. That's what happens with markets. You build up a lot of risk and then the risk comes out. So the high yield market was building up this risk in energy in 2013, 14, and into 15. And then we had oil drop from $100 back down to, I think, 30. And that caused
rough days for the high yield market.
Yeah, rough days for the high yield market.
15, 16.
So that was a shock for high yield. High yield had outflows for some period of time after that. And so the high yield market has been in really fix-it mode since then. And so you fast forward to today, a lot of the excess is wrung out. So high yield energy has dropped from maybe 20% of the index down to something more like 10. And the composition of the index has gone from a heavy weight of single B risk to now it's more than half double B. So it's much higher quality. Another thing that's happened, really accelerated post-COVID, is secured bonds. That really historically, the high yield market has been mostly an unsecured market.
Sure, yeah.
But recently we've seen growth in secured paper, like the cruise line we were talking about. So that really means that you have higher credit quality today than you had in prior years, and I think that just makes high yield maybe safer. It means there's probably less yield opportunity, less total return because you're safer, but it's a higher quality for sure.
What's the yield of the index and the kind of the interest rate risk of if you just bought the index? Not that I'm suggesting anyone
you
should
have
do that.
about a yield of about 5%.
In a world of 20 basis points on short-term treasuries, it's lower than history, but it's not that bad in the big scheme of things.
Right, and you have carry, it's about 50 bips a month of carry, so duration of 3.5. So there's a place for it in a portfolio.
Sure.
Loans are different. So loans haven't had the flushing. Loans have been building up risk over time. If you remember in 2014, 2015, everyone was clamoring, rates are rising, rates are rising. The only asset class to own is floating rate. So floating rate bank loans, CLOs, anything that had a floating rate was a hot thing. Yep. So that built up the risks. That really have.
What percentage of bank loans goes into the CLO machine right now? That's a big topic people are talking about.
Well, it has historically been in the 60s, probably 2/3. I'd say now it's even higher. I don't know if the new numbers are out, but I'd say it's probably closer to 75 or even 80.
Wow, that's very high.
So that is the machine for financing bank loans. But so those risks have built up. And so I was talking about high yield that was more than 50% double B. If you look at bank loans, it's almost, or the majority of it is single B. That's probably 35, 40% single B. So you have this risk that hasn't been dealt with through a cycle. What would normally happen in a normal downturn like we had in March with the onset of COVID is you have companies default, you have leverage start to abate, and then downgrades happen, and you start to see improving credit quality in that market or in any market. But bank loans really haven't had that. So because of Fed liquidity, there was a sharp snapback. Indirectly, because the Fed isn't really buying bank loans, they're financing in a loose way CLOs. But bank loans really got saved by the high yield market. So the Fed started buying the high yield ETFs, and so that provided capital to bail out the bank loan markets.
Historical companies that used to go to bank loan market now went to high yield.
They went to high yield. So a bank loan that may have run out of liquidity and was on the precipice of default, now here comes the high yield market with a secured piece of paper to extend the runway. So that kicked the default wave down the road and gave companies time for maybe a recovery that's coming. So high yield, the bank loans are lower quality right now, just looking at ratings.
Used to be the opposite.
They used to be the opposite. Yeah. If you rewind, bank loans were very high quality with a tilt towards double B, even triple B. But then over time, as the market got hot for floating rate assets, the risks built over time. Sure. Bank loans they do trade mostly below par, so you have some level of convexity. There are more stressy credits, I believe, in loans than in high yield. If you were to just stratify by yield, a simple way, so the market's pretty efficient. So if you were to look at yields, a lot of the high yield market is inside the average yield of the market of 5%. So there's reflecting that high quality. But if you start looking wide of the index, that's really where loans, we start starting at like 5+, there are more loans than bonds. There certainly are high yield bonds that yield 5, 6, 7%, but as a percentage of the index, bank loans have more. So it just demonstrates that there's more stress remaining in that market. And to some extent, maybe some more opportunity. Talking about how CLOs are the bigger buyer, or the majority buyer of bank loans, they have a real hard time holding really low quality credit. So low single B and triple C is a problem. There's a specific basket where CLOs can't hold more than roughly 7.5% of triple Cs. So those credits are getting sort of abandoned, and that's the opportunity. When there's really no buyer because your normal buyer has to get rid of it or at least can't buy anymore, that's the opportunity to step in. And so I feel like that's kind of the sweet spot for finding opportunities.
Yeah, that sounds familiar to me because that's kind of what happened in mortgages. It's nice not being in the middle of the financial disaster this time around, but you had a bunch of mortgages that used to be high quality, 3 trillion of them, and they got downgraded, and most of the people that owned them, insurance companies, money managers, pensions, banks, they couldn't own these junk bonds, so they had to sell them, right? And it's like these big structural changes in the market that create longer term opportunities, not just prices are down for a month and you buy the dip. Right. So it sounds, we've talked about this at the office, it sounds like this theme of in the bank loan market is a potential kind of longer term opportunity is going to be these triple Cs. So it sounds like today you like high yield better, but the opportunities to come, there's probably going to be more of it in that bank loan market in the triple Cs.
I'd probably say high yield is more stable, but I don't necessarily like it better. It depends on the portfolio.
Depends on the bond, I guess.
Depends on the bond, and it depends on the portfolio. Certainly not all high yield is trading at par. There's plenty of stressy credits in the high yield index. And those, if you pick name by name, there are opportunities. There's things we're buying. There's an aerospace company we're looking at, which is actually a second lien bond, talking about secured. So, like you do in structured credit, you can pick your spot in the capital structure in corporate credit to figure out how you want to play things. So aerospace is clearly a risk right now because airlines are at 30% capacity now. There's a lot of excess planes out there. So you could look at an aerospace company and say, well, that sounds pretty frightening. But if you pick the right part in the capital structure in this aerospace company in particular, we feel like even if they default, which is not the base case, there's enough value there, thinking about loan to value, that we can get our money back because we're playing mid part in the cap structure. There are subordinated bonds that really require a recovery in the aerospace industry, which I don't think we're there yet. But there are ways to play in this example without having to believe that everything's going to come back to the way it was. So there are opportunities in high yield, but clearly the CCC part of bank loans, there are credits that sort of become abandoned. Part of it is because they're small. So that really, if you want to talk about the real sweet spot, find the names that aren't in an index, that maybe are too small scale for some of the bigger managers that need to buy $200-300 million per name. Maybe there aren't, and there's no one involved. So maybe there was 30 lenders. So you have to, normally that would trade amongst the other 30 lenders who all don't want to own it. So if you have capacity to get up to speed on that name, or maybe you've covered it and you were lucky enough to get out, you have some knowledge of it, then you can get back in and you're buying in somewhat of a closed market where there really is no liquidity. You are the provider of liquidity.
Sure, and that's when stuff's the cheapest,
that's
right?
when things are cheap, as opposed to fighting it out amongst everyone else for the top 10 names that make up J and K. You got to really be fast to grab something before everyone else sees it. So those opportunities are quite fleeting. It might be there for an hour or two, but then if you don't buy it at that moment, then they go away.
Well, that's March in a nutshell, right? If you had money, you could buy really high quality assets being sold at fire sale prices just because there literally was no bid.
Yeah,
right?
I think of March.
Why don't we talk about March a little bit?
Yeah, I think of March as free money being given away. So here you're talking about in August, it's about doing credit work and finding the right opportunities through doing substantial due diligence. But I view March, maybe a small window, but there was a window of a couple weeks where it was free money. And I think of when household brand names are being sold at deep discounts of 30, 40 points, yields of double-digit yields on companies that are investment grade in many cases, that were trading at 2-3% yields, and all of a sudden you can get 15% yields. Those are things that's giving away free money. We saw it in investment grade, we saw it in high yield, and we saw it in bank loans. So really the best trade, if you could grab it, although it was very difficult, was to buy investment grade in early March when it was basically being given away.
Yeah, I mean that was more people had to sell, they're getting redemptions, and I think that period of time was so bad because the third week of March, our last day in the office was Thursday the 12th, and Friday the 13th was our first time working from home, everybody, right? And the next week's when things got really bad. I think on that Sunday, the Fed announced it's $700 billion of treasuries and agency mortgage-backed securities, and then a week later it was QE infinity, right? It was QE4 to QE infinity in less than 7 days. But nobody was set up to take risk, right? That's the week that everybody was evacuating their Wall Street trading desks. Traders were literally working on laptops at the kitchen table in their underwear. Right. I joke.
On a cell phone.
Yeah, and it just didn't really set up for risk taking. So it just seems like that same setup won't probably happen again.
Not while the Fed's involved. Yeah. So credit markets normally, in a normal recessionary environment, look like March for a longer period of time. And that provides an incredible wealth of opportunity as things play out. Because first you have liquidity flushing, and normally it takes time for people to step in. It doesn't take days or weeks. It normally takes months or even a year
like 09.
For people, like 09, for people to start coming in and saying, you know what, things aren't that bad. There are ways to invest in this market. Not every credit is going to default, and you start to draw money in. But during that repricing period, there are incredible values. The problem is it snapped back too fast, so it was very difficult to.
And that was, what percentage of that you think was because of the Fed?
The vast majority.
Yeah.
I don't think that I don't think it was people saying, I know that there's going to be a vaccine for COVID, and I'm sure things were going to turn back. That's not how investors were speaking in March. I not only spoke to clients, but I was hearing from other managers. And the one thing you heard is uncertainty. Everyone was saying uncertainty.
That's one of the big things I think that took prices down. One was the supply demand, the no bid scenario, which is partly due to regulation and the removal of things like prop desks by the Volcker rule. And then the next thing was uncertainty, because nobody knew how many people are going to default on their mortgages, how many people are going to pay their rent in multifamily, how many people are going to go out and spend money, right?
Can people even leave their house?
Yeah.
So because of that, it created this huge amount of uncertainty. So I don't believe it was the market participants feeling really confident and stepping in. I think it was people saw the Fed, and maybe that was created.
And then once the prices started going up, it was kind of the chase the rally.
Right.
Yeah,
that's right.
And it was very hard to buy.
Incredibly difficult. That's been something that really characterizes this period of stress, is the lack of liquidity. I would speaking in our daily calls about how the markets in high yield and loans would switch from offer only, so you couldn't get a bid on anything, to bid only, where you couldn't get an offer on anything. So it was this oscillation of the market being liquidated to being only bid, and it was very difficult to trade in that environment. And so we'd go through waves where that would happen, and then it would stabilize. But if you look at over the last 5 months, it's been, I think, characterized by a period of poor liquidity because of this bouncing around of investor sentiment.
All right. Well, so what's your outlook, I guess, for the rest of the year, and then looking past the election for 2021? Do you think we continue to see the risk on? Everyone seems to be pretty bulled up on risk assets. To be sure, the data does continue to get better. A lot of medical breakthroughs potentially happening on vaccines or testing. All these things can help us kind of open the economy up. So what are your thoughts on the rest of this year, and then looking forward to 2021?
In a way, it's kind of more of the same. We have an election to deal with, but thinking about portfolios, I generally don't like to take regulatory risk because it's highly unpredictable. So people ask me, well, is your portfolio prepared for a Biden versus Trump presidency? And the answer is it should be for both scenarios, because you're really talking about regulatory outcomes. And so we don't make big bets on that.
So where's that? That's a lot of the stuff in healthcare?
That would mean healthcare. There's going to be winners and losers on healthcare based on whether Biden or Trump is elected. Clearly energy. We talked about energy. Yeah. Energy could be further decimated if Biden becomes president. And then there's other areas like telecom and so on. There are pockets of many sectors that have regulatory risk. So I think just sidestepping that is an issue, or is the right thing to do, and then focus on areas that really won't be a problem regardless of the outcome. So one example is pharma. So we've been underweight pharmaceutical industry for some time in our portfolios because of what you hear in the headlines about generic pricing. The government is now scrutinizing the game of taking generic drugs and raising them, 1,000%. There's an opioid crisis, and there's been companies now are being, under scrutiny for that. So staying clear of that is really the way we manage the portfolios. I imagine the markets are not going to be a straight line from here to next year. There's going to be pockets of volatility. So it's making sure you manage risk, make sure your exposures are proper. I mean, that's, I think, a key. Risk management is absolutely essential right now. Don't be overweight just by accident. Know what your positions are, know what your sectors are, know what your positions are, and manage through that. I think with the strength we're seeing in the market now, it's almost a time to maybe, trim some of the risky stuff that has worked.
Run up a lot, yeah.
And then look for pockets of opportunity when there's volatility. So it's a little bit of trading. But I think more broadly, if we think about what's it going to look like from, over the next 12 months, we've seen sequential improvement in most credits. And that's what's given me the confidence to feel like this market is on the right path.
Yeah, you were saying you've been listening to a lot of the new earnings reports, and companies have kind of prepared themselves to handle what's been thrown at them, right?
Yeah, exactly. I mean, the biggest surprise, which we've talked about, is gaming. I mean, who would have thought they'd recover that quickly? But they're seeing sequential improvement on a month-by-month basis. But you're really seeing that across the board. Airlines, they're in terrible shape, but they're seeing sequential improvement in their volumes. Autos, same thing. So if you see that sequential improvement, you can make a really, reasonable, educated guess that this time next year things will be better. But I think you have to assume also there's going to be some period of volatility. We have to get through an election. There's likely to be some macro exogenous shock that's going to give everyone a scare.
Hopefully not another pandemic.
I mean, there could be, maybe not a pandemic, but seems like we could have another, I don't know if it's a second or third wave of COVID that could cause another scare. But if we see this sequential improvement, you can invest around that thesis of things will get better over time, maybe in a year to 18 months.
All right, well, I hope you're right and things do get better. We get through this crazy election and hopefully next year we'll be a little bit back to normal. So now we've got some questions from the audience. The first question is, during COVID, what's the funniest thing your kids have done to entertain themselves or entertain you?
To entertain me? That's a good question. I don't think they've entertained.
You have teenagers, right?
Yeah, I have teenagers. So no, there hasn't been anything, not a whole lot of entertaining. I'm just trying to keep them in the house. So the funniest thing they've done, I don't know. I don't have a good story for that. I've just been trying to lock them in the house and be responsible. So I don't think anything really entertaining.
Yeah, so you're worried about them not leaving. Yeah. We're trying to teach them about masks, which is super weird right now and awkward. When we go on walks, sometimes we make the kids wear masks. I have 3 little kids, 3 under 5. And they keep asking, why are you wearing masks? And I tell them, oh, people are sick. We just worry, are they going to be hypochondriacs one day? When we go on ride bikes, I let my kids not wear the mask. And another family came by, and my son covers his mouth with his hand like it's going to save him or something. So it's cute, but it's, We
don't have that paranoia. It's more like, are you sure I can't go out with my 5 friends?
I know. They want to go to their COVID parties.
So maybe I'm just a downer on the whole thing. I'm killing the fun.
That's right. It's Dad's job, right?
It's my job.
All right. Question number 4 here. What do you think is going to happen to the airline industry? We talked about it a little. It seems like it's getting better, but
smaller. They're going to have a smaller footprint. I think it's going to be a long time before people start paying $10,000 for a first-class ticket to fly international. So the airlines had a massive network flying to not only international destinations, but lots and lots of regional destinations across the U.S. I think that footprint has to shrink. If you think about business travel,
I think business travel is going down.
You don't need to fly to New York.
Companies are saving millions of dollars right now on travel. Millions of dollars on travel, hotel, business dinners, and things like that.
So I think it means that leisure travel will be the thing that comes back first because people have pent-up demand. They want to get out of their house and go places. So that seems reasonable. That will come back, but with a price-sensitive consumer. But the high end, charging for the business class and the first class tickets, last minute business, I think that's going to be very slow. And it probably won't come back to the 2019 volumes for quite some time. All that means just
can we consolidate even more than we've already have? I mean, we're pretty consolidated in the U.S.
I mean, we have 4 airlines. I suppose you could fall down to 3, maybe. Then maybe you have antitrust issues. I don't know. It starts to get pretty small.
Yeah. All right. Question number 3. What's your favorite meal? Is that type of food or is it breakfast, lunch, dinner? I skip breakfast.
I think in a post-COVID world, I'm starting to dig junk food. Pizza, burgers. It's just comfort food in a stressful time. So that's my go-to.
I'm going to go with the meal of the day. I skip breakfast, so dinner's my meal of the day. Everything kind of builds up until it's like the one thing you have to look forward to, right?
That's right.
What bottle of wine am I going to open up and what am I going to eat?
Yeah, that's right. You can't leave the house. You're not going to work, but at least you can have some food.
That's right. Question number 2. What did you get your degree in and where did you go to college?
Yeah, so I have an undergrad degree in economics from the University of Arizona. I stayed in the Pac-10 and went to USC for my MBA.
Okay. I went to USC as well. I got a degree in business, very straightforward and boring. Real estate finance, didn't know I was going to get in mortgages, kind of ended up in real estate in a haphazard way. And I'm pretty happy that we didn't hire Clay Helton because we'd be paying a lot of money for no football this year, unfortunately. And question number 1, last question from our audience. What advice do you give to the next president?
I think the best advice I would give to the next president is do what's not politically expedient. People talk about this difference between a politician and a statesman is politicians think to the next election cycle and statesmen think about what's right for the country. I think that's what we need. Someone who can look beyond the next cycle and the politics of the moment and think about what does this country need in the long run. That's the advice I would give.
Yeah, I'm going to agree with you. It seems like we're pulling forward returns, and we're pulling forward economic growth today, and we're going to suffer for it tomorrow, and our kids are going to suffer for it tomorrow. So I think let's start thinking about the future. Let's fix the education system, right? Let's not just worry about what's going to get me the next votes, as you say.
Think about education. Think about the jobs of the future. They're not coal. In technology and precise manufacturing, things of that nature. That's what the country needs to focus on.
Yep. All right, well, thanks for making the trek down from Calabasas here to the office. We're like one of, I think, 10 people in the office right now.
Yeah, that's right. Yeah.
Feels pretty safe. There's less people here in the supermarket, so I don't feel in danger coming down here. It's just awkward seeing downtown LA so dead. So hopefully next time this year, it's we're back in action and people are coming back to the office.
Thanks for giving me a reason to leave the house. It's a nice break from working in my little home desk. So, it's been fun. So thank you.
Thanks, everyone.